So see here. So in the previous session, we started with the second area of capital budgeting, containing the advanced capital budgeting issues. Mainly first starting with the concept of replacement decision. I told you main target for the today's session, first we need to complete the replacement decision. Once completed, we need to move on to the area called as inflation in capital budgeting. Once that is also completed, we will be moving on to the next very important area called as decision tree. In decision tree, there are two types of questions: joint probability decision making table and cumulative probability with joint probability decision making table. It takes a lot of time. Around 3 hours we will spend only on the concept of decision tree, because one question will take a lot of time. If we complete early, very good. Maximum time is 3 hours, minimum time will be 2 hours minimum. Listening? In between the 2-3, we will complete of decision tree as well. So first point number 1, we need to start with the first area called as a replacement decision. I told you in the first part of the session already, what is this replacement decision? What happened? So the name of the concept is replacement decision. So name of the concept is replacement decision. So let us see how this let us see how this replacement decision actually works. See here. Whenever we buy a machinery, there will be a life for this, which means life cannot be infinity. I told you, company requires machinery for infinite period, but machine life cannot be infinite. There will be a limit for the life of the machine. Therefore, every number of years, some number of years, 2 years or 3 years or 3.5 years or 2 years, 5 months, like that, we need to replace our old machine with a new machine. What is the right time for replacing the old machine with the new machine is called as the concept of replacement decision. There is one question given on this. Let us first try to solve that. Please note down this question. Discount rate 10%, cash flow details. As I said you already, first we will do the self-made illustrations. Once after that, we will do the problematic part from the exams. Don't write the theory below. Write down up to plus 150. You are copying remaining also. Shall we begin? Recording close చేస్తారా? Sorry, see here. So listen. So how the replacement decision question has to be tackled? See here, I am taking the same information once. Okay, see here. Now you answer me. I will ask you a question. What is the life of this particular machine? What is the life? 3 years. Means when the life of the machine is 3 years, we are having 3 options. Option number 1, replace at the end of first year, replace at the end of second year, replace at the end of third year. Tell me what are the 3 options available? Replace at the end of first year, replace at the end of second year, replace at the end of third year. These are the 3 options available. You can't replace today because today only you are buying. So 0 year replacement concept will not come. Use it for 1 year, go for replacement. Use it for 2 years, go for replacement. Use it for 3 years, go for replacement. Do you understand what I said? Now use this and answer. Point 1. I used for 1 year and I sold. Okay? Tell me, if I use for 1 year and if I sell, what will be my inflows? 900 is my inflow or not? Next, 650 is my inflow or not? Next, what is my outflow? 400 is my outflow. 1000 is also my outflow. Listening? Answer my question now. How much is the investment? How much is the inflow? Again, what is the scrap inflow? How much is the first year cost of the particular project? Net can we calculate NPV? That will be the NPV of that particular project for how many years? 1 year. I will ask you a question, answer properly. First, point number 1. I can replace in how many ways? How many options are there? Option 1, replace at the end of first year, replace at the end of second year, replace at the end of third year. These are the 3 options available. Okay, answer. I will write first, don't copy along with me, please listen. What is the option 1 available? Replace at the end of first year. If you replace at the end of first year, first tell me the series of cash flows. Tell me. Year 0, what is there? Cash outflow. How much? Minus 1000. Year 1, what are the 3 types of cash flow that I am getting? Please answer everyone. Revenue, you are getting how much? 900. Year 2, you are having a cost of how much? 400. Listening? Huh? Oh, okay, sorry. Year 1 cost, and year 1 you will sell it at a scrap value of how much? 650. Okay, these are all the summary of cash flows if you use the machine for 1 year and replace it. Listening everyone? Tell me, what is the option 2? Don't total all these. All those belongs to different time periods. Some people are totaling them and giving me the answer. Some people told me now, minus 1000 plus 900 minus 100, minus 100 minus 400, minus 500, minus 500, 650 plus 150. See, yes, correct. Correct. If you do that in exam, he will die. So, tell me, option 2. Option 2. Replace at the end of second year. Replace at the end of second year. Please answer me. Year 0. Cash outflow. How much? 1000. Next year 1, not year 2. First year revenues will come. So tell me, year 1 what will come? Revenue. First year is same. Along with that, second year also will add to you. Hello everyone. Tell me, how much is revenue? 900. Next year 1 what will also be there? Cost. How much? 400. Next year 1 what also will be there? Scrap. How much? 650. Wrong. If you sell it at the end of first year, how you are using for second year? Ide batti ante. So over. Year 1 is over. Next one is year 2. Tell me. Year 2 again you are getting a revenue. How much is revenue? 800. Cost will be 350. Now scrap can be taken or not? So scrap value has become 400. These are all the cash flows if you replace the machine at the end of which year? Second year. Please also like this. Tell me option 3. Tell me what is option 3? Replace at the end of third year. Now you should only tell me first one year 0. Cash outflow. Year 1. First one is revenue. Second one is cost. Revenue. You can see here revenue 900. Cost 400. So 900, 400. Year 2. Revenue, cost. Scrap taken or not to be taken? Not to be taken. How much? 800, 350. Next year 3. Revenue, cost, scrap. Tell me, what is the revenue? You have the information with you? Tell me how much? 700, 350, 150. These are all the various cash flows. Now listen carefully. These are all the summary of cash flows if you replace the machine at 3 different periods. Okay? So tell me now, can I add any of these numbers directly? No. These are all belong to present or future. Future. Same future or different futures are different future. Therefore, you can't add any of these numbers. You have to bring them into present value and then you have to do. That's the next stage we are going to do. Step number 1, the summary of all the cash flows. Everyone understood clearly? Copy down. Keep the heading. Step 1, summary of cash flows. Summary of cash flows. Write down like this. Complete up to here. Sir, understood all the summary of cash flows written there? Everyone understood all the summary of all the cash flows written there? Why resound is coming? అది ఓకే రీసౌండ్ వస్తుంది ఏంటంటున్నా సరే ఓకే see here. Understood up to here clearly? Now listen. So whenever question on replacement question comes in exam, maybe in the very next attempt it can come because it's very important. Replacement question comes. First of all, step number 1, always write down the summary of all the cash flows. Actually, this is not the answer. But if you write this, mistakes will not be committed while doing the answer. Understood the point or not? Okay. So listen carefully. Shall we? Why this is important? In this question, in the question that what I prepared there, whatever you are seeing there is cost of maintaining the machine. There is a scrap. There are revenues from the particular machine. Correct or not, everyone? Maybe in examination they may tell like that. If you use the asset for 3 years, if you use the asset for repairs and maintenance, cost will be covered by warranty. Covered by, in that case, you will not write the cost for the 3rd year holding period. For example, if you hold the asset for how many years? 3 years, they may tell that if the holding period of asset is 3 years or more, then the buyer and the seller will give the free warranty. Means no cost need to be incurred by you. Everything will be covered by the warranty itself. But provided you hold it for how many years? 3 years. Like that if I give first year 1 year holding, 2 year holding, cost will come. 3 year holding cost will not come. This is one of the examination question given. Did you understand what I said? If you hold for, then the cost of that 3rd year holding will be there or will not be there? Will not be there, because from 3rd year onwards they will give free cost bearing. That means cost of repairs or maintenance you need not bear. That will be covered by the warranty. Clear, everyone? Like that they may give a question in exam, so be careful. That's why write down the summary of all the cash flows when a question came. First write down the summary of all the cash flows. But one important observation, all the cash flows belong to the same time frame or different time frame. Everyone? NPV, if I hold for 1 year, NPV, if I hold for 2 years, NPV, if I hold for 3 years, will be same or will be different? Answer. Because inflows and outflows are changing. Shall we do it? Let's do it together. Keep the heading. Step 2. Calculation of NPV under various options. Under various options. Okay. Write down the schedule properly. Year, cash flow, PV at the rate of, sir, entire answer is having a PV factor of how much percent? 10%. Next one, PV, CF. You tell me, I will write it. First, 0 year, there is an inflow, no outflow, no? Outflow, how much? 1000. Next, PV will be 1000. Year 1, listen carefully. Year 1, there is a revenue, there is a cost, there is a revenue and cost. So net you tell me, how much is the revenue? 900. What is the cost? Tell me. Net how much? This will be 500. Year 1, you are also going to get another inflow. What is that inflow? Sir, never merge scrap flows with the revenues. Scrap is not a revenue. Scrap is not a, it is a capital gain. Okay, na? So don't mix the cash flow with revenue. Revenues are different, scrap values are different. So tell me, what is the scrap? 650. 10% at this particular rate means, what is the answer? 0.909. Next one is 0.826. Oh, sorry. Sorry. Yes. My mistake. 0.909. 500 into 0.909. 450. Round number you do and tell. 650 into 0.909. 5. We need to take disco again. Already taken. Already taken. NPV, you tell me. 40. Negative. Write down. So this is under option 1. Shall we do the second one together? Please, everyone, participate and do together. Nothing great. Tell me. Year, cash flow, PV at the rate of 10%, PVCF. Tell me. 0 year, what is outflow? 1000. Next. Very important. Year 1. Tell me. Year 1, I am having a revenue or cost, revenue and cost. Scrap will be there or will not be there? Will not be there because you are holding for how many years? 2 years. First year scrap will not come. So directly write down 500. You know the meaning of this 500? Already we calculated in the option 1. 0.909. Value is 455. Be careful with the second year. Tell me, second year, what is the revenue? What is the cost? 800 is the revenue. 350 is the cost. So technically, what is the answer? 450. Again, second year, we are also getting some scrap. Tell me the scrap value. 400. 0.826, 0.826. 372. 158. Are you all doing? Don't copy from the screen, please. Not that great answer we are not doing. The normal calculation only. Ideology of representation is important. Remaining anyone can do. Have you done with option 2? Keep the heading option 3. Year, cash flow, PV at the rate of 10%, PVCF. Year 0, 1000, 1 and 1000. Everyone be careful. Answer number 1. What is the first year inflow? 500. Number 2. What is the second year inflow? 450. Very important. Third year, 2 cash flows will come. Tell me, what is the first cash flow? How much? 700 minus 350. So answer is 350. Next, you will also get a scrap. What is the worth of scrap? 150, yeah? Okay. So write down the PV factors as well. 0.909, 0.826, 0.751 and 0.751. So 0.909 into 500, 455, 372, 263, 113. Two zero three. Okay now. Shall we continue? Now you answer me. Completed writing. First tell me what is the step 1? First we created that. From that if you do like this easily you can find the answer. Because you have a summary table, fastly you will calculate the numbers and you will put there. Over. Step number 2. Now tell me, after seeing step number 2, decision. Tell me now, where if you replace, higher NPV is coming. If you replace at the end of first year, you are getting higher NPV. Second year, you are getting higher NPV. Third year, you are getting more NPV. Where you are getting more volume of NPV. So therefore, what is the decision? Replace the machine at the end of third year. Wrong. All the 3 are belonging to 3 different time frames. EAB has to be calculated. Or else why this concept becomes more popular here? You can't compare 1 year cash flow with a 2 years cash flow. Same 2 years cash flow with 3 years cash flow. Either bring everything into repetition or bring into per annum. Obviously, which model will be suggested? Per annum is only suggested because repetition becomes difficult at some point of time. Listening? Let's begin. So therefore, now we need to calculate EAB. Write down. Step number 3. EAB. First tell me what is the formula for EAB. NPV divided by PVAF. You have NPVs with you? We have PVAFs with us. Just we need to calculate the NPV divided by PVAF. Shall we? Right now. Option 1, option 2, option 3. 3 options are there. First write down A. NPV. I would tell the values properly. NPV plus 46 plus 158 plus 203. B. What is the PVAF? So there is only 1 year. What will be the answer for the PVAF? 0.909. Next. No. 0.909 plus 0.826. How much? Next. They don't just copy. Everyone do it on your own. How much? 487. Okay. C. EAB. NPV divided by PVAF, which represents A by B. Tell the final answer first. 50.61, 90, 0, 81.62. Tell me. On a per annum term, if you see where you are getting a higher NPV, first option or second option or third option? Second option. Therefore, it is advisable to replace the machine at the end of second year. This is the final answer for this question. Everyone understood the concept clearly? One clap if you understand. Everyone in the class understood how to do the replacement concept. Tell me what are the 3 steps. Don't forget the steps. First one, summary cash flows. Second one, NPV. Third one, EAB. Don't forget to do that. Directly taking the NPV, don't write judgments in exam. Because all the 3 are belonging to 3 different time frames. One is a 1 year cash flow, another one is a 2 years cash flow, another one is 3 years cash flow. You can't compare like that. That's why what we will calculate? EAB, EAC. How to calculate EAB, EAC? Already know. Okay. With this, we completed one of the techniques in the advanced level. What is the concept? Replacement method or replacement cycle. This concept has been completed. Or replacement decision. Come back to the learning objectives. Come back to your learning objectives. Pick the replacement decision. Pick the replacement decision. You have the learning objective replacement decision. Pick that. Each and every concept we have to cover. Once self-illustrated questions covers all, then we will do another how many questions, sir? 27 questions in capital budgeting again. Then you can be pretty sure about the exam questions that are going to come. Sir, shall we go to the next area? Replacement completed. Next area we are going to start is another horrible area called as inflation. Keep the heading in the notes. Inflation and capital budgeting. Inflation and capital budgeting. Inflation and capital budgeting. Shall we start? Everyone, shall we? Listen. Before starting this concept, I am giving you one caution notice. ఓవర్ యాక్షన్ చేయకుండా వింటే అర్థమవుతుంది. అయిపోయింది, ఇదే కాషన్. నైస్, వెరీ గుడ్ ఫర్ రియలైజేషన్. బట్ లిసన్ కేర్ఫుల్లీ. ఐ నో దట్ టైమ్ బిట్వీన్ 3 to 4:30 is a Rahu Gandam time. I know, but I can't stay without doing any problem or any concept during that time. I know that's a very dangerous time. Dangerous timing will be 3 to not even 3. 2:45 it starts till 4:30 it will be. Okay, so I will take enough care. Okay, enough care represents I will call some persons, they will come on stage, they will explain the concept also now, so that at least they will lose their sleep. By hook or crook I should make you to listen to the class na. మైకింగ్ కొట్టుందా? రెడీ చేయండి చెప్తా. వీళ్ళు నేను ఊరికి వెళ్ళడానికి సరదా అనుకుంటున్నారు. దాంతో చాలా పని ఉంది అని చెప్తా. కొంతమంది హిట్ లిస్ట్ లో ఉన్నారు. హలో హలో హలో, దీని వాల్యూమ్ కూడా ఇంక్రీజ్ చేయండి. హలో 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 హలో. వర్కింగ్ వెల్. సో బటన్ నొక్కమంటారా? నేనున్నాను. Let us do inflation and capital budgeting first. See that how this inflation, a very big story. I will try to tell in big way only. No shortening of stories in capital budgeting. A big story in capital budgeting which given rise to a concept called as inflation with capital budgeting. But lucky is, if I do this here, forex again international capital budgeting will come. Which one? They really, it will take 5 minutes only for us. Anyway, this time I have to spend there. And rather than doing that, I will do here. So as the next chapter, we are going to start with forex. Directly we can jump into the concept. Shall we? Listen. Where this problem all started, please everyone see here. Suspend doing other works. Shall we? Listen. What is NPV? What is NPV? I didn't ask what is the full form of NPV. First question. What is NPV? It is the difference of discounted inflows and discounted outflows. It is the excess of recovery over the principal and return. Excess of recovery over the principal and return. We paid return, we paid principal, even after that if any excess is still remaining, we call that concept as NPV. See the screen now. Capital budgeting is an exercise of understanding whether to accept or to reject the project. Okay. It will help you, the techniques of capital budgeting will help you to arrive at a safe answer or a safe destination, whether this project is an acceptable project or not to accept project. Whether to reject or accept, we can understand by using the techniques called as capital budgeting techniques, 7 techniques, whatever we have already completed. Listening? Here started the whole problem. Sorry, answer, I will give one small illustration. You only tell me. Here, cash flow, PV at the rate of 10%, PVCF. Our well-known example I am writing, 55,000, 80,000, 15,000, 0.909, 0.826, 0.751, 49,995. You need not turn pages, I remember. 11,265. This you also know. 127,340. 1 lakh is the cost. 27,340. This is the answer. Okay. Now see here, please. Intention is not to remember this question. Intention is we should understand how these numbers have come. Tell me. What are all these? Everyone? Those are not profits. Those are all. Please tell me how you got these cash flows. Reverse calculation, you tell me. I will feel very happy if you tell correct answer. First cash flow. Plus depreciation. Give you profit after tax. Next. Minus plus will give you EBT. Or EBIT, interest is not there. Next. Plus depreciation, EBDIT, plus variable cost. Contribution you forget. Don't bifurcate fixed variable. Sorry, cost I will write. Okay. What I will call it as sales. This is the thing. Correct? Now if you interchange and reverse this, means same thing you can also interchange, you know. Okay, forget about that. But it starts like this. Tell me, read and tell. First one, sales, costs, EBIT, depreciation, EBT, tax, PAT, add depreciation, arrive at cash flow. This is how we calculate it, correct? And now question starts. Cash flow comes from 1 year, 2 year, 3 years. Here, in the part, how many years information we are taking? Everyone. So, I am taking sales of 1 year, 2 year, 3 years. 1, 2, 3. I am taking cost of 1 year, 2 year, 3 year. 1, 2, 3. We will be getting EBIT for 1, 2, 3. Depreciation for 1, 2, 3. All like this 1, 2, 3, 3 years we are taking. Correct or not? Here the problem started. What happened in analyzing this capital budgeting is, I told you one example. Okay, what example I told you? Take a cash flow. Hit it with the PV factor. With what name you hit it, that will come out. Correct or not, everyone? If you hit in the name of return, return will come out. If you hit in some other name, that with what name you are hitting, that will come out. Okay? Now the question. Problem with this is, you are taking sales. Please tell me, what do you mean by sales? Start again. Start again. Still think. Reverse this and tell. Minus cost, EBDIT, minus depreciation, EBIT or EBT, EAT, plus depreciation cash flow. Correct? Now, in the question, they have given sales cash flows. In the question, they have given sales cash flow. They have given end result origin. Problem is with the origin now. What happens in the origin? There are some estimative problems. Let us see what are they. Please concentrate properly. Concept is very complicated. See here. What is sales? What is sales? Number of units estimated to sell into sale price per unit. Correct, everyone? Everyone, tell me what it is. Estimated to sell. One small question for you. Please answer. Okay. Tell me, when I am writing 1, 2, 3 in the years column, those are already happened, yet to happen. Guaranteed, estimated. Certain, uncertain. May happen, definitely it will happen. That when I say may happen, there is also chance for may not happen. That means these are all guaranteed, remember, sir, estimated, sir. See the screen. Tell me, sales means what? Number of units estimated into sale price per unit estimated. Sale price per unit. Okay. Now, I estimated 50,000 units to sell first year. How many? 50,000 units to sell in the first year at amount of 1.1 rupee. At an amount of 1.1 rupee. 50,000 into 1.1. How much? That's how we got this 55,000. Listening, Sir, cash flows we got. Let us understand sales here. Forget, those are cash flows only. Sir, forget about everything. 50,000. This example you forget now. I am not telling about this. Separate standalone example I am taking. Tell me, how many units I am expecting to sell? Which year? At a price of how much? What is my sales? Answer? Very good. My sale price is how much? 10. Next year sale price 10 and next year sale price 10. Number of units will be same, changing. I am estimating that number of units will be 60,000 after 1 year. 60,000 after? It will become 70,000 after 3 years. These are all guaranteed. All are estimates. Everyone, these all are estimate. These all are what? Estimates. Estimate may be right, may be wrong. May be right, may be wrong. Now tell me, costs. There will be material cost, labor cost and overhead cost. Correct? Everyone? Let us say there are no fixed costs. Understanding sake, there will be. But example say, let us assume that there are no fixed cost. Tell me, how much will be the cost? Number of units into 6 rupee. Number of units into next year. 60,000 into 6. Next, 70,000 into 6. EBDIT will calculate. Depreciation anyway, it will be same SLM method if you follow. EBT will be the tax calculated, EAT, depreciation, and you are adding back the cash flow. Finally, you are getting the result. Correct or not, everyone? Now, analyze the first two rows properly now. Tell me, first year, what is the sale? Next year? The next year? Now you answer. Those are all guaranteed bond paper written agreements, estimates. May happen, may not happen. Listening. Believing this, believing that really company will give 50,000, 60,000, 70,000, people will put their money in the company. I will give you example. Company started a project, okay, estimating how many sales in the first year. Start again, no proper response. Start again. Company has invested in a, start again. Company has invested in a, estimating how many units to be sold. At the end of next, at the end of next, at the end of, these are all guaranteed estimates. To sell like that, first I need to produce or not. To produce, I need to invest in the plant and machinery, current assets, working capital or not. Who gave you money? Two people can give. Equity, debt, or a combination of both. Answer. When they give money, they will ask a return or not. Who will ask a return? Who will ask a return? Equity shareholders and debt holders will ask a return or not. Debt return is called as? Debt return is called as KD. Equity return is called as KE. Both returns are called as KO. They will ask a return on their investment or not. Now when they ask, there are two parts in PV factor. First class we learned. What are the two parts? Opportunity cost, inflation. Everyone repeat. Everyone. What is opportunity cost? Risk. I told you this in the introduction class. That's why I told you that introduction classes are very, very important. So you may think that I am talking some nonsense in the introductory class. I said very clearly, capital budgeting chapter is entirely dependent on time value of money chapter. When I say I am not just joking and not with an intention to keep you engaging. Really, capital budgeting is dependent on time value of money. Okay? Start. Tell me. Company raised money from how many sources? Number one, debt. Number two, therefore, what is the cost? KIA, KDA, K1. Let us assume that way. Listening? They started doing the project. So why the people has to give money? Answer. Return to be given to the means what company should earn or not. Company estimated cash flows like this. Tell me, how much sale they are expecting at the end of first year? Second year, 60,000. Third year, these are all guaranteed estimates. Estimate means satyana, uncertain. That uncertain means there is a risk or no risk. What is the risk? What is the risk I am asking? Opportunity cost. What is the risk here? 50,000 may be sold. 50,000 may not be sold. Repeat. 50,000. Second. 50,000 may not. Second year. 60,000 may be sold. 60,000 may not be sold. What is the risk in third year? 70,000 may be sold. 70,000 may not be sold. These three are the risks involved in the project or not. Everyone, this is called as real risk. Everyone, repeat. Repeat. Real risk means risk really there in the project. Risk really there in the project is called as. That's why if you go to RBI website and check real rates in India, you will get the real rates also. They will give industry-wise real risk, pharma real risk, real estate real risk, entertainment real risk, power sector and utility real risk. Real risk is the risk of that particular project. Everyone repeat. Everyone, real risk is the risk of that particular. I will ask a question. Market is in recession. I think you know what is a recession. What is a recession? Recession is a time where people are not having enough money to buy the products. Enough money to, then you will get your expected sale. Your sale may not reach expectation. That means your 50,000 what you thought 3 years back may be right, may not be right. Correct or not? Now tell me, who is taking risk? Company is not taking risk. Safeguard no data whether wade. Company is the safest person. Do you know why? Company is an artificial person. It will just play with the money. It will gamble with the money. It is not in their hands. Who will suffer at the end of the day? Investors are of how many types? Ek. Number two. Number one. Number two. Number one. Number two. From this, what is the moral of the story? Who is taking the risk of this unexpected sale? Investor is taking it. Therefore, what he will ask? Return is expected in the form of PV factor. From there we are coming now. Listening? Start from the beginning one more time. Tell me. These all. Listen. What I said till now? Answer ya. Analysis వస్తే ప్రతి క్వశ్చన్ కు 100 సార్లు అనాలేమో నేను. See there. Point number one. How many sale units we are expected to sell at the end of first year? Guaranteed? Certain? Therefore there is a risk? No risk? Who is taking that risk? Investors are taking risk. For the risk taken, what they will ask? Return. Compensation they will ask. Correct or not, everyone? So this project itself is subjected to a risk. Correct? That subjected to risk concept we call as a volume risk. What risk it is? Means there is a uncertainty of selling a volume of 50,000 units. Uncertainty in the selling of volume of 50,000 units. I may sell, may not sell. If you sell 50,000, these are the cash flows. If you sell only 30,000, Hamfat, no NPV. Who is taking risk? Therefore, they will ask A. They will ask A. Till now, we have seen this particular area. Capital budgeting, the first part of capital budgeting, we have done so many NPV questions or not. PV at the rate of some percentage you are taking or not. Why you are giving that amount? For the risk taken, we are giving a return for them. For whom? Now starts the real story. Tell me, how much is the sale price per unit today? Answer. Next year. Next year. Where is inflation? 10 rupee product will sell same 10 rupee for the next 5 years. Did you understand my point or not, everyone? It's a classic example here. When I started printing my AFM books for CA final, first edition I released at first 599. 6 months after it became 799. Now it became 1099. Are you understanding or not? Cost I am talking, not the number of units. Number of units will be in thousands. I'm talking about cost. Cost is 599 first. Next it becomes 799. Next we made it 1099. Reason I will tell you. When we started printing color page printing 2.5 years back, cost of color page printing on a bulk of 1000 books or 2000 books, cost used to be somewhere around maybe, if I am not wrong, 1.1 or 1 rupee they used to take for color printing on a bulk basis. If you go normally, they will take 10 rupees. I am not talking about individual. I am talking about 2000, 3000 bulk printing. They charge 1.1 rupee or 1.2 rupee maximum. 1 rupee. 2020-22 ending, they increase the prices. It became around 1.4 rupee now. Today 1.7 rupee is the cost of each page for us. If you give 2000 bulk printing, now tell me, cost of book printing is same or different? Then means what is there? Inflation is there. Prices will increase over a period of time. It will not remain the same. Correct or not, everyone? But till now, all capital budgeting questions we have done ignoring inflation. Everyone, all capital budgeting questions done till now, we ignored. We ignored. Loudly we ignored. Means with what assumption we started doing the questions? Sale price 10 all the 5 years. Okay. The most another dangerous thing we have done is costs also we assumed same. Tell me, labor will work in the factory at the same rate every year. They will ask for an increase. Wage unit per hour wage rate. Say for example, per hour we are paying 100 rupee now. How much? Skilled labor is there. Per hour we are paying 800 for them. Sorry, 100 rupee for them. Sorry, I'm very sorry. 100 rupee for them. Per day they will get 800 rupee. 1 year completed. Company resulted in a good profit. Company is growing. Obviously, what they will ask? Higher rate. At least 10 or 15 or 20 you hike the salary. Wage rate will be increased. Means their wage cost is inflated or not inflated. Where you are considering there? Same 6 rupees, 6 rupees, 6 rupees, 6 rupees, 6 rupees. All the 5 years you are considering the same 6. Who will do like that here? Tell me, in this cost, what are the 3 costs there? Everyone, correct? Start. Material, labor, overhead. Let us discuss about one by one all the things. Material cost of this year and next year, my paper cost like same or different? Increase or decrease? First tell me that. Generally, they experience an increase. Sir, we do projects with a amount of a conservatism. Which one? Prudence they call that. Means we don't expect any gain, but we expect losses and what to say, the drops in the values of the assets or something. So we always go for a pessimistic attitude when we are doing a project analysis. Correct or not? Sir, if prices reduce, you will get profit. If you get profit, happy only, na? Problem is with if it doesn't happen, a problem will come. Therefore, no project will be analyzed using deflation. All projects are analyzed only using the inflation as a base. Understood the point or not? Please see here. Let's understand. Tell me, cost includes 3 things. Number 1, number 2, number 3. Material cost of this year per unit, next year same or different. But you are considering it as Next one, labor charges, wage rate will be same or different? But here we are considering it as a, next one, what is the third one? Everyone, rent increases every year. Electricity charges unit price increases every year. Answer, yeah. All other indirect costs, generally they tend to increase every year, correct or not? Then where you are considering that? Now did you understand the point? How you should give the results to the management? MD is there. He is asking, analyze the project and give. This is your analysis. 50,000 into 6, 60, 50,000 into 10, 60,000 into 10, 70,000 into 10. 50,000 into 6, 60,000 into 6, 70,000 into 6. Are you understanding? He will throw you outside the company. Reason is, this is a bad analysis of a project. Yeah. Till now, whatever we have done in the capital budgeting as a chapter, it is lacking one practical reality. What is that practical reality? You didn't consider inflation. You are considering only what? Risk of the project inside the PV factors. Listening. What is not considered? Tell me, beginning stages of our class. PV factor is made up of number one, number two. But till now, in all the problems we considered, opportunity cost only. What we didn't consider. Now we are going to consider inflation also. How to do, I will tell you. Before that, listen carefully. Tell me, sale. This year, what is the selling price per unit? Answer. Number of units. Inflation affects the volume. Inflation affects the price. I told you on the day number 1. This point also I told you. iPad inflated means iPad inflated. Cost of iPad inflated. Sales inflated means sales inflated. Sale price inflated. Therefore, we will sell this product at the same 10 rupee. We will increase. Let us say there is a 10% increase. 10 rupee will become 11 rupee next year. 11 rupee will become 12 rupee, 12.1 rupee in the next year. Listening. Tell me, how much is the price today? 1 year after it will be 10, it will be 11. 11 will become 12.1. This is the sales after taking inflation, without taking inflation. Very good. Next, cost. How much is the cost? Answer. Let us take costs inflate by 20%, not by 10. Inflation of costs and sales need not be same. Tell me. 6 rupee become 20 rupee, 20% increase. Tell me. 7.2. Next. 8.64. Tell me now. Now, EBDIT is with inflation, without inflation. These are not EBDIT. It is EBIT directly. Tell me. This is with risk, with inflation, both with risk and with inflation. Tell again. 50,000 contain risk, no risk. What is the risk? Uncertainty risk. 50,000 is having what risk? 10 rupees is having what? Very good. 60,000 is having what? 10 rupees is having what? Next one. Not inflation risk. Inflation. Next. 70,000 is having what? Uncertainty risk. వాడాల్సిన చోట ఎత్తేసి ఎత్తేయాల్సిన చోట వాడేసి. Start again. 50,000 will have faster. Secret solo prof 50,000 will have. 60,000 have. 70,000 have. 10 rupees have. Next, 6 rupees have. One clarity, now tell me. Then you calculate EBIT. You calculate that EBIT is with risk. Everyone tell me, with risk. Everyone, with risk, with inflation. Next, you will get tax, EBIT, add back depreciation. You will get the cash flows. Correct? Now, the cash flows what you get will be having risk element, inflation, both. This is a first thing. Okay. When you go to the management, just 1 minute, still concept is there. When you go to the management and put the papers on their table, okay, you said, sir, 50,000 is the units, 10 rupees is the sale price, next year 11, the next year 12.1, 6 rupees, 7.1, 8.4 is 8.64 is the cost. These are all the cash flows you put before him. Listening or not? He will accept it or not? He will again throw it on your face. He will ask, who want all this information? Who want all this information? I am not asking you to give me information with this. You take risk, you take inflation, you remove both of them and then show me. Listening or not? But first year, what is the sale? Number of units 50,000. Sale price how much? Sale price how much? Price, not sales value. Sale price 10 rupees. What is the total? 5 lakh. What is the cost? 3 lakh. What is the EBIT? 2 lakh. What is EBIT? Next, tax 30%. Okay, 2 lakh into 30% will be answer. Remove that 1 lakh 20. Like that we have taken depreciation not there. Assume all these things. Okay, 1 lakh 20. 1 lakh 20 is having the risk. Is also having inflation inside it. Correct? You have taken this, sir. Management you went, you gave him and said, sir, these are the results of our new project expected. This contains both in risk as well as inflation. He will throw it on your face again. Reason is, first time he will throw on your face because you didn't even consider inflation. Listening. Actual results after 1 or 2 years, inflation will affect the project. In our analysis, inflation is not there. Correct analysis or wrong analysis? So we should consider inflation, not to consider inflation. Everyone. So we considered inflation and took the papers. Again they will throw it on your face. Reason is, you consider risk, you consider inflation. I don't want these bloody answers. I want removing the risk of the project using PV factor, removing the inflation using the PV factor. After removing inflation, after removing risk of the project, what NPV remains with us? Show me that result, he will ask. Did you understand what I said? Understood the point clearly? Yeah. So, tell me, starting point, what we need to consider? First, what we need to consider? Risk. Second, what we need to consider? Inflation. Both you consider first. Calculate the cash flow. Calculate the cash flows. After that, calculate the NPV. Tell the columns. Here, PV at the rate of some percent you have to take or not. That person should have risk and inflation of both. How to include both into that? That's the concept we are going to see now. Understood? So in this particular area called as inflation in capital budgeting, we are going to target to understand how to calculate the PV factors in that rate, which contains both. How to calculate is the subject matter of discussion in this particular area. To explain that, I explained all these things. Everyone understood the point clearly? So we are now going to calculate the PV factors containing dash and dash. Now, this is first part of discussion. Second starts now. Listen carefully. See here. They said there are 3 types of cash flows. Cash flows are of how many types? 3 types. See here. Money cash flow, also called as nominal cash flow. Second one. Listening the first one. What is the first cash flow? Money cash flow or nominal cash flow. Example, any name can come. At that time, nominal cash flow he didn't teach in class, don't tell. Money cash flow, nominal cash flow, both are same. Next, first one, money cash flow, nominal cash flow. Second one, real cash flow. Everyone. Everyone. Next one is, you know this last one. Arey, answer, yeah. What are the 3 types of cash flows? Money cash flow, real cash flow, discounted cash flow. Exam, they will twist in all possible ways. They will give money cash flow, ask you to calculate real cash flow. They will give real cash flow, ask you to calculate money cash flow. They will give real cash flow, they will ask you to calculate discounted cash flow. They will give money cash flow, they will ask you to calculate discounted cash flow. Anything can come in exam. We are going to do the problems on all. Listening everyone? See here. First one, tell me. First one? Second one? Third one? Likewise, these are types of cash flow. Like that, there are three types of rates. Three types of rates. And a PV factor rate. Whenever I said from the beginning of our class, rate is a amount or rate is a percent. There are three types of rates. 1 second, please, everyone, listening. Last benches also. Some are not visible. Bro, you move back. Yes. Bro, you also move like this. Move this side. Thank you very much. Yes, thank you very much. He is hiding, that's why. Your intention may not to hide. You are a very nice person. You are a gentleman, I know, but still, I couldn't see you. He is only not surrender. Okay. So listen, see there. There are three types of cash flow. First one, second, third. Rates are of how many types? Three types of rates are there. Listen, first one is called as inflation rate. First one, what rate? Second one, real rate. What rate? Third one, money rate, also called as a nominal rate. Third one, money rate, also called as nominal rate. Tell me, what is the first cash flow? Inflation cash flow. Na? Meditation చేసేవాడికి కూడా ఇరిటేషన్ తెప్పించేయగలరు. Tell me, what is the first cash flow? Second, third. What are the three rates? అడిగిన చెప్తే చాలు. So now, so first point number 1. What is this? This will compensate for inflation. This will give compensation for inflation. Just now I told, investor is investing in your project. That means they are taking a risk. Along with that, they are also subjected to inflation. For that, we will compensate here. PV factor is nothing but compensation paid to the investor. Correct? Till now, all the problems, whatever we have done, we compensated only for what? Risk. We didn't compensate for inflation. Take a cash flow, hit it with PV factor. With what name you will tell, that will get separated. Correct? Till now, take the, this PV factor is made out of risk. When you hit it with, what will happen? Risk comes out. I mean, for the risk, return will be given, remaining will be separated. Correct? Here, we are not taking PV factor at the rate of risk. We are taking PV factor at the rate of risk, come inflation inside. Clear or not, everyone? So then we will hit it. Then two things will get separated now. What is that? Risk and inflation. That separation we can see clearly now. Okay? See the screen. First one. What is the first rate? Second rate. Third one. Okay. Inflation rate compensates for inflation only. Real rate compensates for risk of the project. Money rate compensates for both. Means both what? Risk and inflation. Everyone, both risk and till now, in all the questions done till now, we have considered IRR, MRR, RRR, and we considered RR is MR. Directly we applied and we have taken answers. Correct? Correct? Wrong? That is wrong. We have done that, but the methodology is correct or wrong? Wrong, because we didn't consider what? At the beginning time of money law, we read that PE factor is made up of two factors. Number one, number two. But we didn't consider inflation anywhere in the capital budgeting decision. Now we are going to consider that. Everyone understood the concept clearly? Now, final answer we are going to come. Tell me one more time, one last time actually, what are the three cash flows? Money cash flow, real cash flow, discounted cash flow. Okay. What is a money cash flow? This contains both risk and inflation. Both risk and? This contains only risk. This is no risk, no inflation. No risk. I have to remove something from the cash flow means what should I do? Take a cash flow. In this cash flow, what are the two things there? First risk, second inflation. We wanted to remove risk. What should I do? Discount with RR. Discount with I want to remove inflation. Discount with IR. I wanted to remove both. Discount with MR directly. Now did you understand the point or not? Whenever I say discounting, it is subtraction and division. Actually it is subtraction, continuous subtraction, but what we will use? Answer. Division we will use. Correct or not? We will divide and multiply that with the cash flow. Okay? See here. Please see here. They said there are three cash flows. Now you will tell, I will write. First cash flow. Which contains both. Discount cash flow na. Mali repeat cheyana mottham. Oddi kada. Start again. Tell me. Me bond the cash flow. Vinandi oka nimisham. Tell me now. Start again. What is the first cash flow? Down to top. Okay. Okay. Now tell me. First one. Next one. Next one. Whenever take a hit with what name you hit, that will come out. Okay. Tell me. First, money cash flow should become. Money cash flow contains both risk and inflation. I wanted to make this real cash flow. Means what I should remove? Risk or inflation? I wanted to remove means I need to subtract, I need to divide. Divide. I need to divide. So 1 by 1 plus IR. What is IR? If I discount this, what will be removed out of it? Fantastic. Next one. Real cash flow contains what? I wanted to remove risk also. Tell me. 1 by 1 plus RR. 1 by 1 plus okay. Instead of doing two steps like this, can I directly take the MCF to DCF? How to do? 1 by 1 plus MR. 1 by 1 plus okay. Now tell me. 1 by 1 plus MR can be written as 1 by 1 plus RR into 1 by 1 plus IR. Correct? Numerators are equal. Can we equate the denominators? Tell me. 1 plus MR equal to 1 plus RR into 1 plus IR. Into 1 plus IR. Money rate equal to 1 plus RR into 1 plus IR minus 1. This is how the formula is derived. In your study material, you will find this formula. How it came, why it came, what they have done, what is this concept? Illa. Are you understanding the concept clearly now? This formula you will find. I will tell you another formula also you will find. Hey, listen, not yet completed. Another 2% still there. Tell me, 1 plus MR equal to 1 plus RR into 1 plus IR. 1 plus RR equal to 1 plus MR divided by 1 plus IR. Correct? RR equal to 1 plus MR by 1 plus IR minus 1. This is the second formula they write in the study material. Okay. These are the two formula here. Study material if you open, you will find these two formula. How it came, when it came, really they didn't even make any attempt to explain what it is. Okay, these are the two formula. Now tell me, why we are doing these two? Don't tell marks sake. Intention marks aithe, I could have told you the formula and do the problems. Answer over. Tell me, why all these here? To separate. Separate what? Separate the risk inflation component. I will go to the management. Okay, I go to the management. I said that, sir, this information of NPV contains both risk and inflation. Then he will ask, remove and show me the answer. Sir, even after removing the inflation, even after removing the risk, still we are having a positive NPV. Confidence will increase now. Correct or not? Then management, MD said, Koushik Mukhesh, you do one thing. Inflation, I am not expecting to happen. Prices won't increase. Keep inflation 0, but put risk on the project and give the answer, he said. Do you understand what I said or not? Keep what as 0? Answer. Keep inflation at 0 level. Okay. As per my estimate, inflation will not affect our project because all the costs are already predetermined by agreement. They can't increase the prices in the next 3-4 years. So we don't have any inflation. We also don't increase the sale prices. Our sale prices will be constant for next 3 years. Prices are anyway constant by agreement. Therefore, inflation don't affect our project. Now redo the calculations, he said. At that time, no sir, on that day I was absent to the class, you can't tell that. Then, on the overall cash flow, you should hit only what? Answer, yeah. Tell me. First, we took the results to the management with what rate? With what rate? MR rate we took. With MR rate we took the results. We took the with what? MR. We calculated DCF. We calculated. He said, I don't want DCF, I want RCF. I want real rate, he said. Then Chachindu Gurre. He don't know how to do the calculation. Now, how to calculate RR? At that time, this formula will help you. Understood the point clearly or not? Like these questions are coming in exam. Management whether management will ask these questions or not, really I don't know. But exam ICAI and these institutes are asking the questions. That means they will ask a question in 2 ways. Direct type of question they will ask you to separate only risk putting inflation 0. Only risk putting inflation at 0. Understood how to do this? Shall we do the question on this now? First, almost 45 minutes to 1 hour I spent on explaining this. Understood everyone? What we completed now? Inflation in capital budgeting. Tell me, what are the 3 cash flows? Money cash flow, discounted cash flow. What are the 3 rates? Inflation rate, real rate, money rate. Whenever you discount something, automatically that will get separated. So inflation rate will be the rate which compensates for the inflation in the project cash flows. So when you apply and discount with inflation rate, inflation will come out. Risk will be there. Apply risk rate, risk will come out. That will be without risk, without inflation. Correct results will come to the management. Listening or not everyone in the class? This is how we have to do the problems. With this, we completed the theoretical discussion on the concept of inflation with capital budgeting. Formula you write down, real and remaining notes I will anyway give you as a PDF. Okay, please write down, keep the heading inflation in capital budgeting. Have you kept the heading? Then write down the notes what I ask you to do. Don't write everything. See here, from here I started my analysis in the main notes. I started explaining each and every point: volume estimate, cost estimate, price estimates. You need to copy this one. Copy down the notes. Repeated writing. Please everyone, anyone writing, please make it fast. Note down this question. Please note down this question. This is how the questions will come. Tell me, these are all the only questions we are going to do. No? These are all examples. If what I said, entire advanced parts of capital budgeting, I will explain with one example first. We'll complete full concepts. Then we'll start doing all the problems. Then you will have a full clarity. Example right on. Investment proposal 8 lakhs. Real cash inflows. Real cash inflows. Which cash inflow? Means what is not there. That's why bracket with today's purchasing power. He clearly wrote in the question. Means it contains only risk inside the project. Monetary cost of capital. Can you please tell me what do you mean by monetary cost of capital? Money rate. Monetary cost of capital means money rate. 9%. Inflation. See there, inflation 3.2% per annum. Life is 4 years project. Compute real cost of capital. Present value of cash inflows in real terms. Compute nominal cash inflow from real cash inflows and also calculate present value on the basis of nominal cash inflows. These are all various questions that came for 8 marks in exam. Note down the question first. Note the question. Please copy down the question first. Right. So now tell me first point. Listen. Cost of capital means what? Rate. Whenever they use the word cost of capital, it's a rate. Real cost of capital means what? Real rate. What rate? Real rate. He wanted us to calculate IRR, MR, RR. Answer. MR given or not given? I see there in Intel. Yeah, MR given, not given. RR given. IR given. Using that both. Just now I told you the formula how to do the RR. Can we start doing it? Keep the heading. Step 1. Calculation of real rate. Calculation of real rate. Calculation of real rate. Write down. RR equal to 1 plus MR divided by 1 plus IR minus 1. 1 plus 0.09 by 1 plus 0.032 minus 1. 1.09 by 1.032 minus 1. Tell the value. 0.056 are also called as 5.6%. Done calculation up to here. Tell me, what is the percentage? What is this percentage? Answer. Real rate. Real rate is how much? 5.6. Next, inflation rate is how much? Answer. 3.2. Next, what is the money rate? 9.99%. Okay. So this is the answer for this particular point. Up to here, everyone understood the point clearly? Yeah. Next situation. See here. Calculation of real rate. We completed step number 1. Next, step 2. See the question properly first. What is the question? Present value. Please listen. Present value of cash flow in what terms? In what terms? Real terms. Means, try to understand. First listen. These 2,80,000 is given in the question. 2,80,000. That is what kind of cash flow it is? What kind of cash flow? Real cash flow means a cash flow which contains inflation or risk of both risk and inflation. Real cash flow is a cash flow which contains both risk and inflation or only risk. Inflation is not there. Listening? He is asking present value of cash flow in real terms. Means what? Take the real cash flow, take the real rate, discount them, you will get a present value or not. Write down. Keep the heading. Two alternatives are there for doing this. I will show you both. First listen. Write down. Calculation of present value of cash flow using real rate. Here, cash flow, real rate at the rate of 5.6% PVCF. Tell me, year 1 to 4, you will get the same cash flow. How much? 5.6 for 4 years annuity. Multiply. 9,79,000. Written up to here. Okay, now tell me, this is NPV or PVCF? PVCF minus what is the disco? See the question and tell ya 8 lakhs. So tell me what is the NPV? Tell me what is the NPV? 1,79,183. Right now, this is the second bit answer. What we calculate, can you please explain me? No. Cash flows are given in real terms, inflated terms, money terms. To bring real terms into discounted terms, we need to discount using what rate? When he used the word present value, we have to discount them. Listening, he is asking present value. Then what we need to do? Discount them. Okay, discount them using which rate? Because the cash flows given are real cash flows. Real terms, they express the cash flows. Okay, next, step 3. Important step. Read the question first. Tell me. Compute. Read the question, yeah. Compute nominal cash inflow from the real cash inflow and also calculate present value on the basis of nominal cash inflow. First, tell me this. He is asking to calculate discounted cash flow, real cash flow, money cash flow. It should exclude inflation, include inflation. Exclude means you will divide. Include means what you have to do? Multiply that. Clear, everyone? 2,80,000 contains inflation, do not contain inflation. 2,80,000 contains risk, no risk. Risk, no risk. Risk. It contains inflation, don't contain inflation. No, now you add it. You add that inflation by multiplying it. Shall we do it? Let's start. Keep the heading. Calculation of MCF and DCF. Here, money cash flow. Sorry. Here, real cash flow, money cash flow, PV at the rate of 9%, PVCF. You might understood why PV at the rate of 9%. 9% is what rate? Money rate. We are getting which cash flow? Money cash flow. Money cash flow should be brought to present value, means you need to discount using the money rate. So please write down. Year 1. No, don't write like that. We have to separate them because inflation is different. Answers will change. 2,80,000 will not be 2,80,000 always. Every year inflation will change or not? Tell me, what is the cash flow for the first year? 2,80,000. Below write down like this. Working note. 2,80,000 into 1.032. Tell me. 2 lakh 960. 960, yeah? Okay. Do it. PV at the rate of 9%, you please tell me the answer. 0.917. Multiply and tell. 2,65,000. 101. Okay. Please tell me for year 2. Year 2. Which one? Year 2. Tell me. First, copy down up to here clearly. We calculated money rate. We calculated money cash flow, sir. Real cash flow, sir. Everyone, tell me. Tell me. What is the real cash flow at the beginning? Real cash flow of this particular project in the first year? That is with inflation or without inflation? Everyone. With inflation, first year ending, what will be the value? 288,960. Next year, that will be the real cash flow opening. Listening, everyone. Tell me. 288,960 into 1.032. 2 lakh 207 PV. 84 value. 990 third. Do like this. 298 207. 298 207 into 1.032 value, please. PV factor 77 580 639 3,07,750. Till the value 59,708 994. Total all the PVCF now. Nine lakh 7 minus 8 lakh. How much? 1,78,729. Both answers are same. Don't see exactly, because instead of 5.62 you have taken only 5.6 here. That small gap will come. This is only way of presentation, that's all. That means when you go to the management, you will show them clearly. Okay, with risk only if you take it is 2,80,000. With inflation if you take it is 2,88,000. After removing both of them it is 265. Like that we will show. Everyone tell me, understood the concept clearly? Everyone understood this problem clearly? Yeah, like this only we need to do the problem. Nothing great. Yeah, question either they will give real cash flow or inflated cash flow or money cash flow they will give. You need to calculate discounted cash flow at the end of the story. Here we are having international capital budgeting in forex. There they will see another 5 questions on this. There you will get more clarity on this. But as of now, whatever we discussed, had you understood the concept clearly and done the problem or not? With this, we completed another area in the advanced area called as inflation in capital budgeting. This is also completed. Hopefully everyone understood. One clap if you understand the concept clearly. Next, keep the heading, the main concept, decision tree analysis. Decision tree analysis. Most important for the exams, decision tree analysis. How it will apply? 2 types of problems we will first do now. One problem is on cumulative joint probability, another one is on joint and cumulative probability. Both the problems, once you have done, you will get a clarity as to how to do this. Okay. So let us continue. Let's start. So the next concept we are going to start is decision tree analysis. Around 2 hours it will take here. Take a break and come. After that we will start. Nice. Thank you very much.